So thank you everybody for logging in and attending our webinar today. Today we're going to be talking about the CalSavers deadline for mid-sized companies. 中型公司申请 CalSavers 的deadline 即将截止了。So we're going to talk about the key facts and alternative plans for your business, 关键要素和其他的计划。So our meeting is mostly going to be in English, and if you are more fluent in Chinese, you're welcome to read the captions on the PPT. So let's welcome our guest, Jeremy Yang. Hi, Jeremy. How are you?
I'm great. Thank you very much. 谢谢.
Thank you. So we're going to have Jeremy introduce himself for a little bit. Do you want to do some introduction for yourself?
Sure. So my name is Jeremy Yang. 我是 Jeremy Yang, and my business name is called Yang's Pension Consultants. We are a second generation family business out in Southern California. We've been here for over 35 years. The business started back in the 80s, late 80s, and we've been serving clients all across the United States. We have over 700 clients that we serve.
That's wonderful. Thank you so much, Jeremy. So I actually knew Jeremy's father as well, because I am second generation as well. So I'm very happy to be working with Jeremy you know, to continue the legacy of our families. So let's go to the next page. All right, so this is a very professional seminar. However, we're gonna make it fun at the end. So as always, we have some raffle prizes at the end, and please stay tuned and we will announce that at the very end. Thank you so much. So 我们后面还有抽奖的活动，所以希望大家注意的听我们今天的讲课。All right, so some housekeeping. You guys are in listening only mode. If you guys have any questions, please go to the chat box, and you can also email your questions to info@EPIA Group and after the webinar. Okay, so the audio is being shared on your computer. If you cannot hear, then make sure you turn on the volume. If you have any questions still, please contact us. All right, so, you know, we're almost at the end of our introduction. We're gonna have our class held by Jeremy, and then we're gonna have a Q&A. At the very end, we're gonna have the raffle. So without further ado, Jeremy, please share your information.
Thank you, Angel. Thank you very much for your time today. We appreciate it. So as I mentioned, I'm a second generation family business, and let me just go ahead and share my screen with you. One second, here we go. Okay, does everybody see the screen?
Yep.
Okay, so we're here to talk about CalSavers today. So CalSavers, what is CalSavers? And answer some questions that everybody has. So today we're going to look at a couple of things. We're going to look at the agenda, the problem. What is the problem here in California that CalSavers is trying to address? We're going to look at what CalSavers actually is, some of the facts about it and how it works. And then lastly, we're going to look at some other options that are out there that are available for clients, for employers who are looking to do something more than CalSavers. Okay, so we're going to look at the problem. We're going to look at the what CalSavers is, and other options that are out there available for us, okay? So the problem is that, and this is something that's been published by the state of California regarding CalSavers, is that there's nearly half of Californians are projected to retire into economic hardship at or below 2 times the poverty level. So because of the lack of savings, there are more than half of Californians are projected to retire at that level. In California, there are 7.5 million Californians that lack a workplace retirement plan, meaning that there is no retirement or no retirement plan for them in the state of California. And for us in particular, for small and mid-sized businesses, 2/3 of the businesses, less than 100 employees, 2/3 of them have no retirement plan at all. No retirement plan at all. And so what is CalSavers coming in trying to address? So CalSavers is a California mandate that employers with more than 5 employees must either offer a retirement plan of the employer's choice or provide access to CalSavers. So California mandate that employers with more than 5 employees need to either offer a retirement plan or provide access to CalSavers. So here's the basic breakdown of what CalSavers is, okay? So CalSavers is essentially an automatic payroll deduction for a Roth IRA. So it's an automatic payroll deduction Roth IRA program. So the first part of that sentence is that it's an automatic. Automatic meaning that it's an automatic enrollment into the program after 30 days of employment. So what that means is when you hire an employee, once the employee reaches 30 days of employment, the employee is then going to be automatically put into the CalSavers program. So 30 days and then automatically in. The next part is that it's a payroll deduction. Payroll deduction meaning that the employee's money is going to be deducted from their payroll and put into the Roth IRA account. The money from the payroll is going to be deducted and put into the Roth IRA account. And this is going to be after-tax money. So it starts at 5% and it increases yearly from there. So 5% and then it increases yearly from there. And the last part is that it's a Roth IRA program, a Roth IRA program, meaning that it is after tax and also limited to all of the Roth IRA limitations as well. So it's an after-tax program that the employers, the owners will need to do for all of their employees, starting at automatically after they've been employed for 30 days and starting at 5% for the employees. So when are the deadlines for this? Well, there are multiple deadlines depending on the size of the business. If the business has more than 100 employees, then the deadline has passed and you need to register immediately. The deadline, because of COVID last year, was extended from June 30th, moved to September 30th. But if we're already past that deadline, so you have to register immediately for that. If you have 50 or more employees, then the deadline is June 30th, 2021. So we have another month and a half, a little bit over a month, and you have to register if you have 50 or more employees in your company. And then the last deadline is if you have 5 or more employees, that deadline is June 30th, 2022. So next year, if you have more than 5 employees, but less than 50, you should register between now and June 30th of 2022. So to recap really quick, it's an automatic payroll deduction Roth IRA. It starts after 30 days of employment with the company. It requires a 5% contribution, and then it's all after-tax money into a Roth IRA that's provided by CalSavers. And then if you have over 100 employees, it starts after September 30th. If you have more than 50, you have another month, and then you need to register. And then if you have more than 5 employees, you have to be registered by next June 30th of next year. Okay, so what other options are there? And why are we looking at other options? Well, first off, there's a couple of limitations for the CalSavers program. There are a few limitations for the CalSavers program. And the first one is that it's a Roth IRA program, a Roth IRA. And Roth IRAs have their own inherent limitations, as a Roth IRA. The first limitation of a Roth IRA is that your contribution cannot exceed $6,000 for the year 2021. So the limitation for Roth IRA for the year 2021 is $6,000. This is indexed, and so it will probably go up next year in the year 2022. But for this year, you're limited at $6,000. If you're 50 or over, the employee can contribute $7,000 because of a catch-up $1,000 contribution. So this is a limitation for a lot of employees. If an employee is making, let's say, about $80,000 a year, and they've been working for you for 3 years, right? When there's an automatic escalation clause, basically saying that after each year, you have to add 1% to the employee's contribution. So by 3 years, you're going to be at 8%. And if we're at 8% and the employee makes $80,000, their contribution will be $6,400, which is already over the $6,000 limit. So if you're over that limit and you contributed more than you should have, that money will be taxed and penalized. So you would have to take it out. If you don't take it out in time, you'll be taxed and penalized. So this is a very important reminder that when you have a Roth IRA contribution automatically done, if you are over the limit, then you have to be very careful, or if you're close to that limit, you have to be very careful how much you contribute into the plan. As I mentioned, with the CalSavers program, it also has very strict rules in terms of when the employee needs to enter in and how much the employee must be contributing. So the rule is that 30 days, right? So when you hire an employee, you have 30 days before you need to have this employee join the CalSavers program. Within that period of time, the employee must notify you to tell you if they do not want to join the program. So they have to tell you, the employer, that they do not want to join the program. 30 days for many people, for many employers, is a very short amount of time. A lot of employers find that 30 days is not enough time to even determine if the employee is going to be there for long term. So they're investing, or they're having to change payroll and make other adjustments for this employee when they've only been there for 30 days. The other part about it is that, like I mentioned before, is that there's a minimum of 5% as your contribution amount, a minimum of 5% as the contribution amount. And every year on January 1st, it escalates by 1%. So first year is 5. And if by January 1st, the next year, it will be 6%. And this will escalate all the way up to 8%. And that's the current rule. This rule might change later on, and it might allow increases up to 10% or even higher. But 5% is the current minimum, and 1% escalation each year. Now, the employee can always choose a lower amount, but that's the current regulation, is that the 5% is the minimum. Lastly, and this is the biggest one, is that there is no benefit for the employer. There's no benefit for the employer. The employer does not receive any, is not able to contribute on behalf of the employees or for themselves. This is strictly an employee contribution account. It's strictly an employee contribution. So that means that employers are not able to reduce their taxable income by contributing for employees and for the owners into the plan. And that's a big issue, because this allows, without the employer contributions, we're not allowing employers to be able to reduce taxable income and save more for retirement. For most of us, saving $6,000 a year is not going to be sufficient for when we retire. And so it's important to remember that there's a need, particularly for owners of businesses, to save for retirement. And this one will be very limiting in that pursuit. So what are other options? Well, we're going to look at some other options today. We're going to look at some IRA options. So continue this along the lines of the CalSavers, which is an Roth IRA. We're going to look at 2 other IRA options, the SEP and the simple IRAs. And then we're going to look at qualified retirement plans. Qualified retirement plans. And qualified retirement plans are we're going to explain the differences, but in general, qualified retirement plans are really beneficial if you have employees and you want to really save a lot for retirement. And in turn, by saving for retirement, reduce your taxable income for this year, for the current year. Okay? All right, let's move on. Okay, so what are the other options? We're going to continue that discussion, and we're going to do that by looking at an example. We're going to look at an example. And what we're looking at today is an owner-only S corporation, okay? An owner-only S corporation with a 52-year-old owner who makes a W-2 of $154,000. So it's an S corp who has one person in the S corp, and they make $154,000. Now, let's take a look at a comparison, and we'll start from there and look at all of the numbers, okay? So the first one is CalSavers. CalSavers, the total amount of contribution is $7,000, $7,000. And that's made up of $6,000 because that's the normal Roth IRA limit, and then $1,000 catch up on top of that because the employee is over 50 years old and older. So they can make $7,000 contribution. Now, that's the CalSavers option. Second option is your simple IRA, your simple IRA. And your simple IRA is a total contribution of $21,000, $21,000. And this is made up of two different parts. It's made up of your salary deferral, as well as a match contribution from the company. So now we're introducing something different, and we're introducing a company contribution, whereas before with CalSavers, it was only an employee contribution, okay? So in a simple IRA, the employee can make $13,500 as their salary deferral contribution. And because the owner, in this example, the owner is over 50 years old, so they can also contribute an extra $3,000. So $13,500 plus the $3,000 catch up. And then on a simple IRA, the company matches dollar for dollar up to 3% of the employee's salary. Matches dollar for dollar up to 3% of the employee's salary. So we know that $13,000, $13,500 is more than 3% of the employee's salary. So 3% of the $154,000, the matching portion would be $4,620. So in total, we have $13,500 plus $3,000 catch-up plus a $4,620 match, which gives us $21,120 as the total contribution. Now, just for everybody's benefit, I made all of the company contributions in red so that you know that this is a deduction from the corporation, a deduction from the company. So that's the simple IRA. The next option is a SEP IRA. A SEP IRA is a simplified employee pension IRA. So this one, it's very simple. It's only one type of contribution, and that contribution is only from the company. So the company can contribute up to 25% of the compensation of the owner. So 25% of the compensation is the calculation for a SEP IRA. So the employee in this case makes $154,000. 25% of compensation is $38,500. $38,500. Okay. So these are your IRA options. These three, CalSavers, Simple IRA, and SEP IRA, are all your IRA options. And just a reminder, IRA stands for Individual Retirement Account. It's that particular employee's account. It's not it's not a pension or a retirement plan. So that's the first three, IRAs. And now we're going to talk about retirement plans. Retirement plans are a little bit different. They're different because they're governed differently than IRAs. They have different limitations, but one of the main things that they do is they allow for different formulas. So for example, we can say, I'm going to give the owners a higher formula as a contribution and the employees a lower formula as a contribution. As long as the calculations pass your non-discrimination testing, then we can do this type of calculation. So it could be that the owners will get 25% and the employees would get 10%. And as long as it passes non-discrimination, then we can go ahead and say that this would be a legitimate calculation. So in this situation, there's only one employee, and that's the owner. And so we're just going to look at him at this time. So for profit sharing plans, it's also the same calculation as a SEP IRA. It's 25% of compensation, okay? 25% of compensation, which again gives us the same $38,500. But again, just to remind everybody that you can use different formulas as long as it passes non-discrimination testing. The next one, the next option for you is what a lot of people know of as the 401k plan, the 401k plan. So this one is a 401k profit sharing plan, and the total contribution is $64,500. $64,500. And we get to $64,500 by using the salary deferral of $19,500. And because the employee is over 50 years old, they can also contribute another $6,500. So plus the last part, which is the company contribution of $38,500. So when you add those three parts together, it comes out to be $64,500 for the year 2021. So an employee, if they have $154,000 as salary, they can get up to $64,500 as a 401k contribution. Okay. The next option, and we're almost at the end, is the defined benefit pension plan. A defined benefit pension plan. So a defined benefit pension plan is a great option for small employers, small to mid-sized employers. And the reason why they're a great option is because you can contribute a lot of money for employers, for owners who are older and closer to retirement. They're older and closer to retirement. In this situation, what we're looking at is not so much the IRS in this situation doesn't tell you a particular amount that you can contribute. It doesn't limit you on what you can contribute. Instead, it limits you on the benefit at retirement. So the IRS defines the benefit at retirement. And in this situation, we can calculate that at the benefit at retirement, when we discount all of those contributions back to this current age, we can calculate a contribution for him of $155,000. $155,000. Now, this contribution is from the employer. It's not from the employee. It's all from the company, which also means that it's a company deduction, reducing the company's taxable income, reducing the company's taxable income. So the defined benefit plan, $155,000. It's very high, particularly for this person because the owner is older and closer to retirement. And when somebody is older and closer to retirement, they have less years for contributing into the plan. When they're older and closer to retirement, they have less years to contribute into the plan. And because they have less years, less time, they have to contribute more money into the plan. Okay, so that's your defined benefit plan. That's a very broad overview of the defined benefit plan. The key point of it is that it's great for older owners, and they have to have high salaries because they can contribute more money if they're older and with high salary. Okay, and then the last one, the last option, we could actually take the two plans before it, the 401k and the defined benefit, and we can combine them together and have one, we can have two plans for one company, two plans for one company. So in this situation, when we add the two plans together, the defined benefit plus the 401k, the total amount for this employee contribution is $190,240. $190,240. And that's $155,000 defined benefit contribution plus the $26,000 salary deferral from the 401k. Remember the 401k, we had these two parts, deferral plus the catch-up. That's $26,000. And then also, when you have two plans together, the profit sharing portion is going to be reduced. So in this situation, the profit sharing is capped at $9,240. So in total, $190,240, of which $26,000 is deducted from the employee's salary. The remaining $164,000 is going to be deducted from the corporation side. Okay, so I know this was a little bit long. This was a comparison of all of the different options, both IRA options, simple, SEP, and then also your qualified retirement plan options. So this is a very helpful page if you are thinking about wanting to contribute more than just the CalSavers limit for yourself, okay? All right, so that's those are the other options. And what a lot of people want to see is a proposal. What does it look like for a company with 5 employees, right? So we know that the rule is when you have 5 or more employees, you have to be registered for CalSavers starting next June. So what is an option for an employer who has 5 or more employees to contribute into the retirement plan? And so what we did was we took the last option, which was the last option that we talked about, which was a combination of 2 plans, and we calculated how much they can contribute for a 5-participant company. So a company with 5 employees, okay? And so this one's a pretty complex slide, but we'll just go through it from left to right, okay? In this company, there are 5 employees. There are 2 owners, both in their 50s, and then there are 3 employees, one that's 54, and then 2 of them that are very young in their early 20s. In this in this example, the 5 employees, they make this much amount of money for each person, okay? And when we do this calculation, we have determined that in a defined benefit plan, they can contribute a total of $280,000 for all 5 employees, okay? It changes a little bit for the owners, and so we just kind of leave that blank. But essentially, there's $2,000 going to the employees, and the remaining $278,000 goes to the 2 owners. Now, when we look at this defined benefit plan, we can note we notice one major thing, and that major difference is that this is the employers, the owners have a different formula than the employees. The owners, the 2 owners right here, have a different formula from the employees. The owners are getting a maximum benefit formula, while the employees are getting a meaningful benefit, a minimum benefit formula. And we can do this as long as it passes non-discrimination testing, as long as it passes non-discrimination testing. And when we look at it just by itself, this does not pass non-discrimination testing. So what the IRS allows is that we can add a second plan, a 401k plan right here. And if we add the 401k plan, we can contribute to the employees in order to pass the non-discrimination testing. We can contribute money to the employees in order to pass the non-discrimination testing. So in this situation, we'll just go left to right again. We have employee deferral. So the owners can contribute up to $26,000 because they're over 50 years old. And the employees can also contribute, whether they contribute or not. It doesn't matter for the owners. They will still have to contribute the same amount as from the company. So whether the employees contribute, $100 a payroll or the maximum $19,500 for themselves, it doesn't really matter to the owners, to the company. And what we determined is that if the company gives $2,700, $2,400, and $1,650 to the employees, they'll be able to pass their non-discrimination testing. This works out to be 7.5% of the employee's salary, 7.5%. So the IRS allows for us to do this. And the reason why it passes non-discrimination testing is because the owners have less time until retirement. The owners have less time until retirement. And because they have less time, they don't have a lot of, they don't receive a lot of benefit from compound interest. Compound interest is not really helping them, right? So if an owner's 56 years old and let's just say this is a 10-year plan, he has only 10 years for him to contribute as much money as possible into the plan. And compound interest doesn't really help very much in that 10-year period. Contrast that with an employee who's 24 or 26 years old, and they have 30 years or 40 years until retirement. Compound interest is going to greatly help their contributions. Compound interest is going to greatly help the contributions that are being made for them. So we're not really testing on the contributions that are going in currently. We're projecting those contributions out to retirement and testing at retirement age. And that's why the IRS says this is non-discriminating against the employees. Okay, so in total, $77,800 for the 401k plan. And a total contribution for the two plans together is $357,800. $357,800. One of the first things that we look at whenever we do a proposal like this is we look at the benefit breakdown. We look at the benefit breakdown. We look at how much does each dollar going into the plan, how much of it goes to the owners versus to the employees. For every dollar that is contributed into the plan, how much of it goes to the owners and how much of it goes to the employees. And in this situation, for every dollar that goes in, 97.5 cents goes to the owners and about 2.5 cents goes to the employees. 97.5 goes to the owners and about 2.5 goes to the employees. Anything, most CPAs will tell you that anything over about 70 to 75% going to the owners, and then on the flip side, 25 to 30% going to the employees. Anything in that ratio is a very good ratio, and it makes sense to move forward with the plan. This one is at 97.5 and 2.5. This one is one of my best calculations. It's one of my clients who have the best census for this type of design. The other factor we use for determining if it makes sense to move forward with this proposal is the summary after taxes. Summary after taxes. And essentially what we're saying here is that if you, assuming a 45% tax bracket, if you do not use this retirement plan design, and you pay 45% taxes on it, you're going to pay approximately $161,000 in taxes. $161,000, which means that you, as the owner, as the employer of the company, you'll walk away with $196,000. So $357,000 gross, and then after taxes, you're looking at $196,000 that the owner keeps for themselves. And now, when we only take the owner's portion, the $349,000, okay, and we subtract it against the tax outlet, we get a net tax savings this year of $152,000. This is not including the employee's portion. So we're just looking at how much the owner can save in taxes this year, and it's going to be very close to around $150,000 if they use this plan design, if they use retirement plans that allow you to do different formulas in their plan design. Okay, so we've looked at today CalSavers. We've looked at what it is, what are the deadlines for CalSavers this year, as well as next year. That the fact that you have to be, if you have 5 or more employees in your company, California mandates, it's a California law that you have to have either a retirement plan or you have to be registered with CalSavers and contributing for the employees, deducting payroll for the employees. After that, we've also looked at the other options. We've looked at each option individually, and then now we look at an option for 5 or more employees. 5 or more employees. Okay, so thank you so much for your time. Right now, we would like to open up the discussion for any sort of questions that people have.
Yes, thank you so much, Jeremy. So we've been collecting some questions for you, and we're going to show them on our PPT. Okay, so before our PPT comes up, what when is the deadline for companies 5+ to have retirement plan for the employees? So thank you, Michael, for the question. Jeremy, maybe you can repeat that specifically for 5 or more. I believe this year is 50 or more, but
Right.
next year, let's look at this little chart right here. Go ahead.
Right, that's correct. So 50 or more, you need to be registered by June 30th, 2021, which is a little over a month. And for 5 or more employees right here, 5 or more, you have until June 30th, 2022. So you have until next June to register for CalSavers for 5 or more employees.
Thank you, Jeremy, for the answer.
Sure.
So let's see if we have any other questions. Backstage, do we have any questions? Okay, maybe we'll have trouble sharing the questions. Okay, so I want to kind of talk about, oh, there's actually a few more questions. Okay, so we have a question from Tony about the penalties. To be more specific about the penalties.
Right, so non-compliance is subject to a $1 penalty. I believe it's $250 per eligible employee, and there's a cap on that if I remember correctly, but it's at least $250 per employee if you're not in compliance with CalSavers. Yep.
Okay, great. And do we have a website for CalSavers?
Right. The website for CalSavers is simple. It's calsavers.com. calsavers.com. Okay. And it's good for both employees as well as owners to look at.
Okay, great. So this is a very crucial question. Somebody asked, who can we work with for this? I understand that you are actually a TPA. You are the actuary. Mm-hmm. So you actually work with financial advisors, CPAs. So us, EPIA as a company, we provide benefits and we also provide the financial advising. Mm-hmm. So if people, our attendees have questions or if they need some kind of advisement, then they would come to us, or do they come to you directly?
Right. So good question. CalSavers is on its own. If you have questions about CalSavers, you would go to the website, register through there, and the employees would then have access. Once you start making contributions to CalSavers, the employees would have access to make those investment decisions on their own through the CalSavers program. For anything else, for the SEP IRA, the simple IRA, for any qualified retirement plans, you would come to either an investment person like Angel and her company as well, or for me, you would come to me as a third-party administrator. So what I do is I design the retirement plans. So the last slide that we looked at, where we had the proposal, I create that sort of a design for each individual employer for the company. And then from the company's point of view, once we establish the plan, they work with an investment person to do the investments. I don't get involved in the investment side. I only do the calculations, the compliance, and then the pension tax returns. So I help the employer file their pension tax returns. I draft the returns, and then on a yearly basis, and the employer files them through electronically. So very simple process.
Yes, thank you, Jeremy, for clarifying that. So I also want to add that most of our clients are they're used to the Taylor service. So with that said, if you are not thinking about CalSavers until the last moment, until next year, or even this year, you will basically default it into CalSavers. So that's something that we actually want to see less of because we do want to, have a tailored service for everybody online today. So let's share with Jeremy our next question. I think we have a few more questions.
Of course. So there was a question about the deadlines again. The deadlines, June 30th for 50 or more employees, and then 5 or more employees is June 30th, 2022. So next June, it would be 5 or more employees.
Yes, okay. So let's go ahead with this Q&A. Can I make contributions to CalSavers on behalf of my employees?
Great. So the answer to this is no. So this is the biggest limitation of CalSavers. CalSavers does not allow company contributions. It only allows employee Roth contributions. Roth contributions, meaning after-tax contributions. And this is a big limitation because it doesn't allow the company to contribute more for owners in the company. So a lot of owners are making more money and they would like to, and $6,000 or $7,000 a year into the contribution would not be enough for them at retirement. So CalSavers' limitation is only $7,000 if you're 50 and over. This is why employers, owners want to look at different options, because the different options will allow them to contribute more money into the plan for themselves and for the employees. But not only does it do that, it also allows you to, whatever you contribute into the plan from the company is a company deduction. So it reduces the company's expenses, meaning that you are paying less in taxes in that year because you're able to put that money away for retirement.
Okay, thank you so much, Jeremy. So we're going to go back and forth between the chat room and our also Q&A on screen. So we do have something about the fees. We have 2 people asking about the fees. What are your fees? And also I want to tell people that our fee for the employee benefits portion, we don't charge a fee. However, there's a financial advising portion, but depends case by case. So how about you, Jeremy?
Yeah. So we charge a fee to the company, and the company pays annual fee to us every year as long as there's money in the plan. And this can vary. So you can imagine that there are some plans that are very simple, where it's a 401k plan with 2 or 10 employees, or a 401k plan with 100 employees. The fee varies greatly depending on what the plan design is and how many employees it is. So for one plan, it can range from $1,200 to $1,300 a year. With 2 plans, it starts at about $2,700. So when you have a defined benefit and a 401k plan, usually yearly it's about $2,700 and up, depending on how many employees and how complex the plan design is.
Okay. So, but with the tax savings and the retirement savings is actually worth the charge.
Absolutely.
So absolutely, with the professional service. So we also have a question and answer in the Q&A. How do employees opt out in the first 30 days? Is the employer obligated to help them with that?
Right. So there is no direction in how do employees opt out. I would definitely say if you have an employee that wants to opt out, that it needs to be done in writing, dated and signed by the employee, of course. And that way you can keep it for your records in the future if anything ever gets audited by CalSavers to figure out if you're in compliance. So within 30 days they need to opt out. After that, they have time periods where they can opt out of the contributions from their salary. Okay.
Okay, great. Can we go to the next page of the Q&A, please? Are all employees eligible for the program? When do employees become eligible?
Right, thank you. So all employees are eligible once they satisfy the 30 days of employment. You can do it less than that, but most people will want to start at 30 days. 30 days is the maximum amount of time that the employee needs to wait before they can enter into the CalSavers program.
Okay, perfect. Thank you. And the next question, do we have any more? Great. What if an employee is already contributing through another employer they currently work for?
Right, so this is the sensitive part, right? And one of the limitations of CalSavers. The limitation is that one employee cannot contribute in the year 2021 more than $6,000 from their salary. So if they're contributing money from one employer and they are working for you as well, you would also, the employee needs to make sure that they cannot contribute over the $6,000 limit. So I've seen employees decide that they only want to contribute at one employer so that they can make sure that they don't exceed that limit, or they have to be very careful and looking at their pay stubs each time to make sure that they don't exceed that $6,000 limit. But yes, if the employee works at one location and one employer and also works for you, then they would be eligible for both.
I see. So they can benefit from both.
Right.
Awesome. So any more questions? Why should I facilitate CalSavers instead of setting up my own plan or joining a multiple employer plan?
Right. So this is how I would think of it as. CalSavers is really for the employer who's not making any money or is making very, very little money in that particular year. So they don't have a lot of tax issues. They don't have any, they're not making so much that they would be subject to a lot of income tax. In that situation, CalSavers is fine. CalSavers allows the employees to contribute. The employees can grow their own money. And then when they leave the company or whatever happens, they can always bring that IRA, Roth IRA account with them to whatever new company they go work for. CalSavers is fine for employers who are not making any sort of income or not going to be profitable that particular year. A multiple employer plan is an option for you. A multiple employer plan is an option for retirement for companies that are are looking for just a very basic or very, very non-design intensive type of plan. So a traditional 401k plan, a very simple one where there's not a lot of design that goes into it. It could be just just a match or something that is very simple to administer. That's an opportunity for a multiple employer plan. But if an employer is making a good amount of money and they're looking at their tax bill, which a lot of people just paid, and they're looking at their tax bill and realizing that they are going to be taxed quite a bit, then this is where your own specific plan comes into play. This is where you would want to contact a third-party administrator like me to help you design a plan that would best suit your situation. And the reason why is because I can help you figure out the best way to maximize contributions and to minimize your taxable income by putting money into the retirement plan. And not only putting money into the plan, but also very focused money. So that money goes more towards the owners and less towards the employees in a legal, non-discriminatory manner.
Okay, yeah, thank you for that. So most of our employers, they're probably really profitable, and
right.
So if they're not, making as much profit, they just want to fulfill the mandate, then they will probably just want less hassle, just go into CalSavers. However, if you do have some assets, you do have some income coming in, we highly recommend that you guys come to us for your financial planning. So let's go to the next question, please. How do I communicate to my employees about CalSavers?
Right. So this is a good question. This one is definitely going to be helped by going to the CalSavers website. The CalSavers website has a lot of employee information. In particular, there's a frequently asked questions area where you can look at all of the questions. There is some downloadable material as well. But mainly, I would suggest going to the CalSavers website and downloading some of that information to be able to pass out to your employees so that they can understand what they're going to be, what CalSavers is. Yeah.
Okay. All right. So I'm going to go into the chat room. People are very enthusiastic this morning, so I love that. So we have a question from Crystal. If we put a defined pension plan in place, even say by Q4 of 2021, can we retroactively apply it to reduce net income in 2021? Or can we only prorate it for 25% of 2021 net income? That's a very specific question.
Yeah, it's a very specific question, but it's a very good question. And I'm sure other employers are wondering this as well. The answer is that if you start a plan in Q4, you can still have the plan be effective for the entire 2021 year. So you can have a plan where you can deduct income for the entire year. You do not have to prorate it. Now, there are certain types of plans and certain types of plan designs that need to be set up by certain dates. For example, if you have employees in your company and you wanted to set up any of the 401k plan, you would want to set that up before August 15th of this year for the year 2021. And the reason is because there are certain types of design elements that will allow you to maximize certain people. But if you wait past that deadline, essentially if you wait past September, then you're going to be past the deadline. You won't be able to implement those parts of the design. So definitely, if you're thinking about it for 2021, the company's earning a good amount of money and you want to contribute or you want to set up something soon for the year, you definitely want to start contacting us, contact me so that we can help you design something for the year 2021 that we can implement in time before that August, September deadline.
Yes, thank you so much, Jeremy. So we're almost up on our time, so we will stop the Q&A that's at this moment. So thank you, my support team in the back. Thank you so much, Jeremy.
Thank you.
Yeah, before we leave, I just want to let people know that today's webinar is hosted by EPIA. Experience is the ultimate protection. Obviously, we're second generation, so we've been around for, we can say, 30 years or so. Is that true, Jeremy?
Yep. Yep.
Yeah, so 16 years combined between the two of us. So I just want to say that today, hopefully everyone learned that, suitability and compliance is very important as an employer. And also know that if you're a 50 plus company, your deadline is June 30th of this year to apply for some kind of retirement plan, either CalSavers or one of the ones that Jeremy talked about. If you are a 5 or plus company, your deadline is next year, which is soon approaching as well. Yeah, remember how fast 2020 went? So just be very careful, start talking to your financial advisors, and don't forget the deadline is June 30th of 2022 if you're 5 or plus employees. So thank you very much. Let's go to the next page and see what we have in store. So basically, we thank Jeremy for coming, and if you do go to Jeremy, please mention that you were here at the webinar, and so Jeremy knows that you guys are already friends. You have the basic idea of what a retirement plan is, and we will provide you with a thank you gift. So next page, please. Okay, so now we're gonna do the raffle draw. So without further ado, let's do the raffle. How are you doing, Jeremy? You're muted.
Great. I'm more calm now after giving the presentation, of course.
That's good. You look calm the whole time. So
good.
Yes, we're very convinced that we do need a retirement plan at your speech. So thank you so much.
Thank you.
So someone says, can we have the PowerPoint? So we do have everything recorded. It'll be posted on our YouTube page. At the same time, we're going to be emailing to everybody who have attended or registered. So we will be doing the raffle. So go ahead. We have 3 gift cards from Target. So let's go ahead. First winner. Michael Lin. Michael, are you still on the line? Congratulations, Michael. So let's do the next person. Jerry Yu. Congratulations, Jerry. 于总，恭喜。Okay, so I just want to make sure that people know that Jeremy is also bilingual. So he speaks fluent Chinese. You want to show off a little bit, Jeremy? Introduce your company in Chinese.
Right, so 公司是叫阳恒金砖，是阳恒是我的爸爸的名字。我们是在这里做了30多年 ，and 是一个second generation, like I mentioned before. 我们这个是做退休计划，只做这个，我们不做investments or any sort of CPA work. 我们只做这个 special, 就是 very niche field. Yes.
Okay, thank you, Jeremy. Jeremy 的中文非常好，所以 we thank you for showing up on the spot. So I just got, so let's pick the next winner, please. Grace Yu, congratulations, Grace. Appreciate your attendance. And before we close this page, Michael just messaged me. He would like to donate his winnings. So we're gonna do the raffle again. We're gonna pick another winner. Thank you so much, Michael, for your generosity. So we're gonna give somebody else a chance. Maybe it's Jeremy, maybe it's me, who knows? Okay, are you ready for that? Daily, congratulations, Daily. Thank you for your attendance, and we will be sending you the gift card shortly. Thank you so much for everyone's attendance. And we're going to go back to our PPT. So we will be emailing everybody a copy. We're going to have the recording. We're also giving you an ebook on CalSavers, overview for employers. Obviously, hopefully after reading it, you realize that what you actually need is a financial advisor and also a TPA helping you really look at what you really need. Next page, please. And thank you guys for attending. Please, we have several websites up here. If you guys can scan, you can check out more information on what services we provide. We also cater to all the employers' needs. We have workers' comp, liability, also, as I mentioned previously, employee benefits, financial planning, and follow us on Facebook and review us on Yelp and Google. Thank you so much. And thank you so much, our speaker, Jeremy. I really appreciate your time and your knowledge, and hopefully, you know, we can do this again. You're muted.
Thank you very much.
Thank you. Bye-bye.
Bye.